Yes, people, a very, very happy morning to all of you. So, guys, today we are going to start with a brand new topic, which is cash flow statement, the most awaited chapter for a lot of people, and one of the most haunted topic of the 12th standard, but not so haunted. Before we start this topic, let's understand from the examination point what weightage does this chapter carry. So, this cash flow statement, guys, is a part B segment, which is a part of your financial statement analysis. Cash flow statement exclusively covers up to 8 marks in the board examination. Out of 80 marks, 8 marks exclusively for cash flow statement, which means 10% of your question is going to come from this particular chapter. Before we start discussing in depth, let's understand what is the meaning of cash flow statement. Before that, what is cash? Cash means cash in hand, cash in bank, anything equivalent to cash is cash here. So about cash, we have a separate session, hopefully today itself, to understand what is the meaning of cash and what is cash equivalent. To understand that, there's one whole segment probably for half an hour. Sir, what is flow? Flow means inflow and outflow of cash. Statement. So we are going to prepare a statement. We are going to prepare a document wherein we are going to capture the information of cash coming in and cash going outside. So if I combine all together, it's called as a cash flow statement. A cash flow statement is a statement where you capture the movement of cashes, the changes in cashes, that is the cash coming in and the cash that is going out. I don't know how many of you have this doubt. I had this doubt when I was learning this chapter for the very first time in the CA intermediate, because in 12th standard state board, we never had this chapter in the syllabus. We were so lucky. So we didn't have to go through all this pain what you guys are going. So I faced this chapter for the very first time in the CA intermediate. And when the faculty started the explanation, he said that same thing. So cash flow statement is basically a statement prepared wherein you capture the data of the money coming in and going out. The first thing that popped up in my mind is that why do we prepare this statement when we already have this information with us? So where do we have this information with us? Cash ledger and bank ledger. If you open the cash ledger and bank ledger, this is cash ledger, let's suppose. Debit what? Comes in. Credit what? Goes out. So inflow of money is here, outflow of money is here. When we have the data readily available, what is the need for us to additionally prepare this statement? I had this doubt. Later I got convinced why this statement is to be prepared. So let me ask you guys, with whatever you have done in school, what is the difference between the cash ledger and bank ledger versus the cash flow statement?
In cash flow statement, we categorize the inflow and outflow of cash on the basis of operating and investing and financing activities.
Okay, with that, what information are you going to draw?
We can take this.
So lovely, he's got a good explanation. But why do we need to categorize that way? What is the objective of preparing that?
External users, so let's say they're investing in a company, they know how the company is working and what are their investments and how.
Is it only useful for the external investors? Yes, for both internal and external people. Okay, anything else? Online people, do you want to add?
Major decisions can be taken by the.
Some decision, major decisions we cannot say. Some important decisions can be taken care upon looking at the cash flow statement. Point taken. Next. Online people, no comments. Only if you participate, I'll understand that you're listening to me. Otherwise, we'll assume that you're not listening to me.
Then we can get to know the cash increase, sir.
We can get to
Know the decrease and increase in cash.
what will you do with that?
So share this information with investors.
Even if you share with the investor, what will he do? Increase and decrease change if he is getting. What does he know? What is he deriving? Or how is it useful for him is my question.
So to know how efficiently we use the cash.
Okay.
So we get to know the weightage of our core business revenue and non-core business.
Very good.
So the way we are going to cover our cost and expenses.
Okay. Point taken.
Sir,
Forgot your point. Very good. Cash book. Cash book is what? Summary of cash ledger and bank ledger. Cash ledger and bank ledger put together is cash book. So here when we capture the information in the ledger, what happens? You capture the inflow and outflow transaction wise. First of all, you capture the information transaction wise. So if I've done cash sale, what is the entry? Cash to sales. What? Yeah, cash to sales. Thinking so much. Cash account debit to sales. So two sales on a particular date. Let's suppose today is 26/11. 26/11, two sales, 100 rupees. Next day, tomorrow, 27/11. Again, you're doing cash sale. So two sales, 150 rupees. Day after tomorrow, you did a credit sale. And after that, the person is paying the money. So when the money is recovered from the debtor, what is the journal entry? Cash account debit to debtor. So to debtor, let's say 250 rupees. You have received interest in your bank account. You have received interest in your bank account. So this is a cash book, cash ledger, bank ledger combining. So I can write that here also. So what is my interest received entry? I'm getting interest monthly. So to interest, cash account debit to interest. To interest, 1000 rupees. 31st December, again I'm getting interest. To interest, 1000 rupees. So you're getting inflow of the money transaction wise. Likewise, outflow, you're paying salary every month. Let's say on 30th of November. What is the entry for salary paid in cash? Salary to cash. So by salary, 100. 31st of December, again, by salary, 200. Employee added, extra salary. Now, if I ask you category wise, for this particular category or from this particular category, how much money is coming? From this particular category, how much money is coming? Are you in position to give me the data first of all? If I want to ask you, what is my total cash sale? That is from the current year, how much money did I receive from the cash sale? How much money did we collect from the debtor? How much money did we collect from the interest? How much money we collected from the commission? How much money we collected by doing services? So if I ask category wise, are you in position to give me the data? Second, if I ask you what is the total payment made, salary total payment done, can you tell that information by looking at the cash book? Cash book, my dear friends, is not a single page document. It runs for several pages. So if I ask you what is the total salary paid for the entire year, you'll be blinking in next second. So this is a raw data. And using this raw data, I cannot make any analysis. I cannot make any decision as the owner of the business. So therefore, we prepare analysis-oriented document. So we extract certain information from the regular accounts so that we can analyze and make some important decisions for our business. Please tell me, what is the accounting process or accounting cycle? It starts with identifying a business financial transaction. Then you measure in terms of money, that is INR. Then you record in form of journal. Recording happens in form of journal. Journal does not facilitate totaling. So for totaling purpose, all these transactions are reposted to ledger. In ledger, once you do the total, all the debit balance item will go to the debit column of trial balance. All the credit balance item goes to the credit column of trial balance. You prepare trial balance. So accounting is a systematic process of identifying business financial transaction, measuring in terms of money, recording through journal, classifying through ledger, and summarizing through trial balance, trading P&L, and balance sheet. So trial balance, trading P&L, balance sheet is what? Summary. From the trial balance, all the accounts which has got the flavor of income, gain, expense, losses goes to your trading and P&L account. And all the other accounts which has got the flavor of asset and liability goes to your balance sheet. These two documents put together is called as financial statement. So accounting is a systematic process of identifying a business financial transaction, measuring in terms of money, recording through journal, classification happens in ledger, summarizing through this, and then after doing summarizing, after preparing the financial statement, is your job over? You have to do analysis. So the next step after preparing the final accounts, the next step after preparing the financial statement is to do analysis. So there are multiple tools that you will use to do the analysis. The first one we learned already in the last class, which is ratio analysis. You analyze the ratios of the business, accounting ratios of the business. Then Cash flow is what now that we are going to learn. Cash flow statement is also an analysis document. Next chapter that we're going to deal with is the comparative size statement, common size statement, and trend analysis. These are the 3 tools of analyzing the financial statement. 3 tools of analyzing financial statement. It does not stop here. Once you go to your higher educations, let's say you're doing BCom honors, let's say you're going for any CA or like professional courses, there when you learn accounting, additional analysis documents will be there. Example, fund flow analysis. Fund flow analysis, again another document. So there are multiple analysis document that you prepare, and each report is good in its own way. Each report will give you the clarity of decision making in its own way. Everybody's got some unique flavor. Ratios will help you in certain way. Cash flow statement is going to help you in certain way. These 3 tools of financial statement is going to help you in certain way. Fund flow statement is going to help you in certain way. So all these are different tools that you prepare to analyze the position of your business, whether it is in good position, strong position, weak position. You get to know the position, and accordingly you can make the decisions. If you remember, I told you in the ratio chapter, when you look at the profitability ratio, a lot of people look at the profitability of the business and they decide that they want to invest in the company. But that would be a serious disaster, because we learned that there are so many other parameters that we have to see. A company which might be profitable now, but if their current ratio is bad, if their liquid ratios are bad, if that ratios which affects the liquidity are bad, then the company which is profitable today, on the long run, it'll run out of money. Once it is running out of money, it will not pay the money to the creditors. If you don't make the payment to the creditors on time, they will not supply the goods on time. If the goods, raw material is not coming to you on time, can you do the manufacturing? Can you do the production? If production is not done on time, can you do the sales? If sales is not happening, where will the profit come from? So the company today which is profitable, because of other weak ratios, it can lead into loss in the near future. You should be able to predict it. And prediction is not blind prediction. We are doing a calculative prediction. So this kind of statement comes handy for us to decide whether, as an owner, am I making mistakes somewhere? Do I need to correct things at certain places? Also, this statement comes handy for people like investors who is investing the money to see and keep a track whether the owner is doing everything properly or not. He has got a own set of team. Investor will have his own set of team who will continuously do the analysis of the company, continuous analysis, because he's investing crores of rupees now. So he has to be very careful whether the person is diligently using the money or not, whether the policies of the company are company friendly or not, or against the company. So like that, there's so many analysis needs to be done. So cash flow statement gives you one such analysis. So what is the ultimate purpose of cash flow statement? Why are we preparing this? What is the objective behind it? What is the analysis we can draw from this? Is what we're going to study in the entire chapter. There is something above and beyond just by-hearting the format and vomiting in the examination hall. There's something above and beyond that. So that is what we're going to look into this topic. There's no way to score in this topic only if you are depending on by-hearting the formula. Net profit before tax and extraordinary item is given. Okay, this comes add, this comes minus. Let me tell you, all of you are in CBSE. How the questions will be twisted in what way, you have no idea. So light misunderstanding of the question, instead of addition, you by mistakenly do subtraction and come, because you by-hearted that way, you're screwed. So it's very important to get the pulse of this chapter in a conceptual way. So are you in for it, guys? Are you in for it? No energy. Offline people, no energy.
Yes, sir.
Online people, no energy.
Yes, sir.
Yes, sir.
Fantastic. So let's begin. Then what did you do so far? And I just get an outer idea. So cash ledger gives you only the raw data where you cannot make any decision. So the cash flow statement will give you from which all sources the money is coming in, category wise, to which all source the money has been applied, category wise. So you can make a lot of decisions there. Now here at this stage, it is very difficult for me to tell how the judgment needs to be done. So once we start doing, I'll explain point by point. I'll give you a practical scenario. That time you'll understand the real essence of this topic. So first 2 or 3 classes will play a very vital role. So please do not miss out on the classes. The first line says that, sir, cash flow statement is a statement that shows the cash flow, that is inflow and outflow of the cash and cash equivalents. So all of you know what is cash. Cash is cash in hand. But what and all comes under cash equivalent? It's a Not mystery. Why mystery? She's telling mystery.
I don't know.
Mystery.
I didn't know.
It's something which we have to look forward to learn. So cash flow statement is a statement that shows the cash inflow outflow of cash and cash equivalent during the accounting period, usually between two balance sheet dates. 31st March 2022 to 31st March 2023. In between 1 year, what is the inflow and outflow of the money is what we are going to see. And these cash and cash flow in and out has to be categorized under three activity, which is called as operating activity, investing activity, financing activity. What is operating activity? What is investing? What is finance? You have to learn in depth. In other words, cash flow statement is a statement that gives information of change in cash and cash equivalent of the enterprise during the accounting period under these three activities. You will not even understand the head and tail of this. This paragraph you have to understand. You need to have the understanding of the entire system of cash flow. Only then you'll be able to understand what they're trying to say. What changes in cash and cash equivalent, what is operating, investing, everything will make sense only when you understand the complete flow. Anyways, I'm just skipping these two paragraphs at the moment. Cash flow statement is prepared as per accounting standard 3 revised. Just a second. Cash flow statement is prepared as per accounting standard 3 revised, AS3 revised. If somebody asks you, the format of cash flow is given by whom? Don't say Companies Act. The format of the financial statement was given by Companies Act. But the cash flow statement, the format is being laid down in accounting standard 3. First of all, what is accounting standard? We have discussed this in 11th standard. You have it in your syllabus. Standard set by board. Which board? Accounting standard board, sir. ICAI. ICAI is one of the board members. They are not the board. They are one of the board members. So accounting standard is basically the rule book that you have to follow while doing the accounting. All of you have studied in 11th standard depreciation.
Yes, sir.
Depreciation, how are we supposed to calculate? SLM method, WDV method. Once you've calculated how to account it, normal method, provision for depreciation method. Who gave all that rule? Accounting standard 10, which talks about property, plant, equipment. There, the structure is laid down that this is how you have to calculate the depreciation. This is how you have to account the depreciation. Goodwill, we calculated, we have learned to amortize goodwill. For goodwill, what is the term that we use? Amortization, intangible asset, amortization, tangible asset, depreciation. So intangible assets should be amortized. This concept is laid down by which accounting standard? Accounting standard 26, which talks about accounting for intangibles. Like that, whatever you have studied so far, some way or the other, it is connected to the accounting standard. It is just at your level, they did not tell you that, okay, this is the accounting standard that it belongs to. For example, in 11th standard, when we did the financial statement topic, we learned that closing stock should be recorded at the cost price or the market price, whichever is less. Whichever is less. Who gave this concept? Though it was based on prudence, but this was finally incorporated where? Here, all of you here. Naturally, it will come then. Here. Accounting standard 2, which talks about the valuation of inventory. It talks about the valuation of inventory. So there it was laid down that taking prudence concept into consideration, inventory should be recorded at cost price or market price, whichever is lower. So anything and everything that you studied so far, everything finally is a topic that is taken from accounting standard. So this cash flow statement also, the format, how to be prepared, what are the different methods, it's all laid down by accounting standard 3. And in the bracket is revised. Why? Because before that there was one old cash flow statement, that is accounting standard 3 was old one. That was redundant, out of date, not applicable for current scenario. So they have since then revised it. So now in the examination hall, they ask you a question. Cash flow statement, the format that is laid down in accounting standard 2, accounting standard 2 revised, accounting standard 3, accounting standard 3 revised. 4 options is given. Which one will you choose? Accounting standard 3 revised is important. No, just not accounting standard 3. It is revised. Further, the accounting standard prescribes the cash flow statement to be prepared either by direct method or indirect method. There are 2 methods that has been suggested by accounting standard. In that, the first method, direct method, is not there in your syllabus because it is very easy. In CBSE, we cannot do anything easy. We want everything to be complicated. That's why we have learned the complicated method, which is indirect method. Easy. This only is difficult. Direct method, not there in syllabus. Indirect method, which is very complicated, is there in our syllabus. Because we CBSE people are known for, we'll do it. Come on. If we can't do it, who will do it? That attitude they want us to exhibit. But our students, direct method, not there in your syllabus. Indirect method is what we're going to learn. So in your syllabus, indirect method only is applicable. So direct method, indirect method is given by whom? Accounting Standard 3, revised.
So in companies, which one will they follow, sir?
Now the question is, in company, in real practical life, which method they follow? Majorly indirect method. But there are certain companies who follow direct method also. So both you have to learn. When you come to CA intermediate, you have both the topics. Indirect method, whatever you're learning, it same is there in CA intermediate. If you have learned this from me, your CA intermediate, indirect method, done. Purvi here. It is prepared either by direct method or indirect method, showing cash flow under 3 heads, namely cash flow from operating activity, cash flow from investing activity, cash flow from financing activity. So whether you follow direct method or indirect method, the difference in cash flow, the movement of cash flow in these 3 activities or from these 3 activities is sure to be shown. You cannot deviate from these 3 activities. That is for sure. Now, sir, for me to prepare, Harshit, the cash flow statement, you have to give me some document. What is the underlying document that we are going to use for preparing of the cash flow statement? Financial statement is the right language. The financial statement, which is nothing but trading P&L and balance sheet. Trading P&L is replaced by the word now statement of P&L. So now statement of P&L and the balance sheet, these 2 documents are the underlying for preparing the cash flow statement. Whereas for direct method, the underlyings are different. This is only for indirect method. So cash flow statement by indirect method is prepared from the financial statement. So if you don't have financial statement of P&L and the balance sheet, you cannot prepare the cash flow statement. So it is purely a reverse working that we are going to learn. That is the balance sheet and statement of P&L of 2 years and additional information. So they should give you the balance sheet of current year as well as previous year, statement of P&L of current year as well as previous year, and some additional information. Only then you'll be in position to prepare the cash flow statement. What is the objective of preparing the cash flow statement? The objective or the purpose for preparing the cash flow statement, the first objective being to determine the source of receipt of cash and cash equivalent under the operating, investing and the finance activity. Can somebody explain me the source? What is the meaning of source?
From where do you get money?
From where did you get money? Guys,
Origin, sir.
in the balance sheet, asset side, you have fixed asset 10 crore. You understand what is fixed asset? Yeah. Then you have investments 5 crore, cash 2 crore, cash in bank, let's say 3 crore. Like that, there are multiple items in asset. From where did the money come, boss? Source, capital. From capital, I would have got it. I would have borrowed money from somebody, or I would have done the business. From the business, I would have got the profit. So that is my source of money coming in. So we have to first understand for a business from which source the money is coming in. Now, a business will be considered as healthy. A business, as per you guys tell me, which business is considered as healthy? Money coming from the core business activity or the money that is coming from raising the funds? Which is the healthiest way of getting the money? Sir, I'm doing business. From that business, I'm generating more and more funds. And using that funds, I'm developing my further business. Is that best? Or getting the money from the banker, getting the money from the investor, getting the money from NBFCs is better? Which inflow is considered as best? Organic inflow. From the business, from your own core business activity, whatever the money comes, no, that is the best inflow. So you will understand that from the core business activity, how much money have you raised? From the investing activity, how much money have you raised? From financing activity, how much money have you raised? And once you analyze it, you have to analyze which is the organic way of raising the money. You know what is financing activity? Raising of funds through equity, raising of funds through debentures or borrowings. We've learned, no? That is called as cash inflow from the finance activity. I'm just giving you a rough idea. I'm not going into deep. Financing activity means what? You got money. You got money by issuing equity shares to the equity shareholders. So you gave shares to equity shareholders, they gave you money. Money came in, cash inflow, source. You issued debenture. You issued debenture, you got money. So that is another way of raising the money. So all this is called as finance activity. What is meaning of finance? Financing of the business means what? Raising of funds. So cash inflow from financing activity. What is cash inflow from investing activity? What does investing activity means? You have invested in land building, plant machinery, investment. You sold them, you got the money. You sold them, you got the money. Cash inflow. Then operating activity, cash flow from operating activity. What does it mean? I'm in the business of buying and selling jewelry. I sold jewelry, got money, profit. I'm in the business of buying and selling laptop, sold laptop, got money. So these are the three sources of money. Category I'm talking about. Out of these three sources of money, which is the healthiest organic way of raising the funds? Cash inflow coming through my core business activity. Olden days, people used to depend on their own business funds. Now, the so-called startup culture, what are they dependent on? Others funds, investors funds, primarily bankers funds. This is how they try to thrive in the business. They want that growth to come in overnight. So they pump in a lot of money, burn a lot of money, brand significantly, but ultimately there's nothing there in the business. So people need to work on the business model rather than the brand image that they're trying to set. How many startups, you say Flipkart, Amazon, Paytm, Zomato, heavy funding, heavy burning of cash, still they're not profitable. On the other hand, the business which is built over a period of several years, which took a lot of blood and sweat of the entrepreneurs, promoters, today they're having huge funds, crores and crores of rupees, and still the company is in profitable stage. So that is the difference between the so-called startup that we have seen today versus the organic business that has been built with the organic ideology. So in the cash flow statement, you will first understand from which activities am I getting inflow, and whatever this money is coming in, how am I applying it? Second is to determine the application of the cash and cash equivalent. Application means what? I'm investing for the operating activity, investing activity, finance activity. Where do I spend money in operating activity? To pay salary. So whatever money I generate in business, first I'll make the payment to the employees' salary. I have to make the payment to the creditor. So this is coming under operating activity. Investing activity means what? Whatever money I got from the first source, with that, I am buying the plant, buying the machinery, buying the land, buying the building, putting the investment. So I need to know from which source money is coming and to which source money is being utilized. Now let me ask you one thing. Now this cash flow statement is prepared, so you get to know from the operating activity you got 100 crore rupees this year. From operating activity you got 100 crore rupees. Now with this 100 crore rupees, in the application stage you're finding that this 100 crore rupees, out of 100 crore rupees, 80 crore rupees is invested in the share market. Good or bad?
Bad.
Now because of cash flow statement, you're able to identify that 100 crore rupees has come inside the business through operating activity by doing business. And looking at the application, you got to identify in cash flow statement that 80% of this money has been deployed in the share market. Is it good for the company or bad for the company?
Bad.
Tell me.
Bad.
So when I see the cash flow statement, I know from where the money is coming, and this money is put into share market, which is subject to market risk. 80% of the money does anybody pump in the share market? Now, when you look at the balance sheet, balance sheet will tell there's an investment. The money which is invested, from where the money is coming, how will you know? To an extent, let's accept it. Sir, I got the profit from the business that I invested, digestible. Imagine a scenario where this person has got the money from the equity shareholder. He's got the money from the banker. Now he's deploying that money in the share market. Is it better?
No.
For a second, we can digest that your money from the operating activity, investing in share market is still fine, because if it is a loss, it is a money loss of the business. But now, We are taking money from the general public, we are taking from the banker and deploying 80% of the funds in the share market, playing a gamble with that. Is it right? Now, in the balance sheet, you know the loan amount coming in. In the asset side, you know the amount invested in share market. Whether this money is what is gone here, how will you know? So balance sheet will not give you that information. So that information is captured through cash flow statement. So cash flow statement will very clearly highlight from where the money is coming and to where the money is being pumped in. A clear-cut idea will be given to you so that as a user of financial statement, you can judge whether this company is good or bad. If this company is taking such a kind of risk, it is very dangerous to be with them. It is better that we exit and invest in some other company. So are you able to understand the significance of this? Third point is to determine the net change in the cash and cash equivalent. The first 2 points where take difference, inflow minus outflow, is the net change. So this net change, through this net change also we can make some decision making. That I'll explain you when I do the practical questions. So these are the 3 objectives. You might get this question for 2 mark directly. In one of the attempt, I don't remember which year exactly, or in sample paper, they asked what is the objective of cash flow. And you know people what they wrote? Nonsense they wrote. Whatever, if they felt like writing, they wrote it. This is one short question I remember seeing. I don't remember exactly, was it in the sample paper question where they wrote it wrong, or was it a board exam paper? I'm not really sure. I can check and get back. But they had this one question: what is objective of cash flow? Direct theory question. What is the objective of cash flow? So in your examination, you can expect at least 2 to 4 marks. I'm telling overall, where you can get a direct theory question. So you cannot ignore the direct theory question also. So what are the 3 objectives? To first determine the sources of money coming in from these 3 activities. To determine the applications of money which is coming from these 3 activities and going into these 3 activities. Then finally is the net change of cash and cash equivalent. Now guys, importance, uses of cash flow statement, limitation. I feel this theory makes sense only when you learn the practical aspect. When you know practically how this entire system works, then when you come and read this, will make sense. Otherwise, this point will not make any sense. You will read it, you will understand it, but you'll not get the feeling from your heart. What are they trying to tell? So these 2 theories will keep it pending. We'll come back and read when we complete doing the practical questions. Now comes the most important part. Definition of the key terms used in cash flow statement. First, we need to understand what is the meaning of cash. You think that cash in hand is cash. No. What you're thinking is right, but here they have explained something beyond that. So here cash, that is in cash and cash equivalent, cash comprises of cash on hand and demand deposit with bank. So my question goes to all of you. What does demand deposit with bank means?
The amount of
MD.
money.
No, sir, based on if you give us the money or bank, sir, we do it anytime.
Harshit, loudly.
Like if you put the money in bank, you can take it anytime you want.
Without any terms and conditions. Very good. Demand deposit. The moment people look at deposit, people think that fixed deposit. No. I have a savings bank account. I have a current account. I go and deposit the money in the bank. Deposit now. So deposit necessarily does not mean only fixed deposit. So I go and open savings bank account. I open current account. I deposit money. If I want to withdraw, will the bank say, hey, you cannot withdraw today, come tomorrow? No, for withdrawing this money, you have to give an application, give a love letter, then only will withdraw. Can you say that? If I feel like accepting it, I'll accept it. Or else you will say friends forever. Possible? So tell me. You go to the bank, you ask the banker, boss, I want my money. He has to give it. Of course, you have to fill the application. Give the letter. Instant you'll get money. On the other hand, you have an ATM card. Go to ATM. Swipe it, you get the money. So which means the money is 100% under your control. Though it is with banker, but when you want, it can come back to your hand. That is called as demand deposit. Demand deposit means what? The deposit that you've done in the bank, which you can get it back anytime without any terms and conditions by the banker, without any restriction by the banker, is called as demand deposit with bank. So the money that is deposited in savings bank account, the money that is deposited in the current account is called as demand deposit with bank. Any problem here? So cash in hand, cash at bank. Both are your cash. Both are treated as cash. Online people, are you getting this point? Hello? Please make a note of it.
Yes, sir.
Sir.
Demand deposit means that the money which is deposited in bank, which you can get it on demand whenever you want it. That is called as demand deposit. SB account, current account, there is something called as flexi deposit, which is there in, what do you call it, discussion in recent times, where the bank will come and approach saying that, sir, in your bank account, any money that is lying idle beyond 1 lakh rupees automatically will put into flexi deposit. So let's suppose in my bank 1 lakh rupees there now. Somebody is putting 2 lakh. So automatically that 2 lakh will automatically go into flexi deposit. Once it goes to flexi deposit, the advantage of flexi deposit is that when you want to make the payment, though this 1 lakh rupees is in normal bank account and 2 lakh in FD account, still this 2 lakh rupees is linked with the normal account. So if I make a payment of, let's say, 1.5 lakh rupees, so 1 lakh rupees will go from my current account and 50,000 without any terms and conditions will go from my deposit account. So flexi deposit is also a deposit with demand deposit with bank only. There are multiple types of deposit. One is this demand deposit, what I just explained. Another type of deposit is, what? You go to bank, say bank, I want to do a fixed deposit for 6 months, which means in these 6 months, you cannot get your money back. You'll get your money back only beyond 6 months. So now restriction is there or not there? It is there. So can I call it demand deposit? No. Demand deposit means what? I can get my money back without any restrictions or terms and conditions. So flexi deposit is flexi going in, flexi coming out. So it is a demand deposit. But if you do a deposit specifically for 3 months, 6 months, 1 year, 2 year, 5 year, then you have a lock-in period coming into picture. You cannot withdraw the money. In some cases, you can withdraw, but you have to pay some penalty charges for that. So all that will come under the cash equivalent. Are you able to follow? So in cash, what does it come? Cash in hand, cash at bank, and deposit means which deposit? Demand deposit, which I can get my money back whenever I want without any further terms and conditions, without any restrictions. Now, cash equivalent is the big challenging part for people to understand. Now, please listen to me very carefully. Very, very important point. Cash equivalents are short term. What is cash equivalent? Something which is short term, first condition. Second condition, it should be highly liquid. Means what? Readily convertible into cash. We have studied what is liquidity in the 11th standard. What does liquidity means? The ability of, we saw also in ratio topic, the ability of an asset getting converted into cash as fast as possible is called as liquidity. So if you are able to convert any asset into cash just like that, very fastly, it's called as highly liquid asset. Cash is liquid form only. Cash at bank also is liquid form only. But if there is anything else which I can convert into, cash in no time, just like that, that is called as liquidity. So first condition of something to be qualified as cash equivalent, for something to call as cash equivalent, the first condition, it should be short term. Second condition, it should be highly liquid. Means what? I should be able to convert into cash just like that. And the third condition should be, it should be insignificant risk of change in value. There should be insignificant of risk of change in value. Now, what does this mean? Tell me.
There should be no risk in, like, if you have something that's liquid, it should, like, when you purchase something that's liquid, it should be sold at the same.
Okay.
Maybe not
Too much of fluctuation value. Yes, both of you added a good point. Others?
It should not be subject to market.
Okay. So basically, risk factor should not be involved, basically. Okay. Others, all in people?
Or this factor should be met by.
Yes. Very good. The first condition for you to call something as cash equivalent, first condition, it should be short term. Second is highly liquid. Third condition is insignificant.
Risk of change in value.
Sorry with the spelling. An accounts person cannot concentrate on language. Insignificant change in value. There can be change in value. There can be change in value, but the change should be insignificant. What is the meaning of insignificant? Very small, minute. Even if it changes, no, it will not give us a heart attack. Negligible. That is called as insignificant. If these three conditions cumulatively satisfy, then we could call something as cash equivalent. Short term means what here? Sorry. Short term, 1 year, you said rightly. but that is the normal context. In the context of cash equivalent, short term means 3 months. So, which means, let's suppose I'm opening a fixed deposit. I put 1 lakh rupees in a fixed deposit. And the term period, lock-in period is 3 months. Lock-in period is 3 months. First condition satisfied? Can I say fixed deposits are liquid? Because when I get the money, I'll get the money in form of cash. It is not in either form. Fixed deposit is in money form. So it is highly liquid. Second condition also satisfied. Third condition, when you get the money back, fixed deposit, will the value will be more or less? It will be more. Here when they're telling that there should be insignificant change in value means what? The downfall should be insignificant. When they're telling that the value change, the change in value should be insignificant, the focus is on the value going down. That they're telling it should be insignificant. Value up, we have no problem. So fixed deposit, the value will either be same or it will be more. It will never go negative. Even if you withdraw prior to 3 months, they will charge you 0.5%, 0.05% penalty. Is 0.05% penalty that they're going to charge is very significant? Insignificant. Chiller fellow. So fixed deposit for 3 months with these 3 terms and conditions, guys. Should I classify that 1 lakh as current investment, or should I classify this as a non-current investment, or should I classify that as a cash equivalent? Because you have deposited 3 months ka FD. It's an investment. So is it my investment that is current investment, short-term investment, or is it a long-term investment, or is it a cash equivalent?
Short-term investment.
Short-term investment. Short-term investment. Cash equivalent. I'm telling if these 3 conditions are going to satisfy, it is cash equivalent. You're telling 100% this 1 lakh is your cash equivalent. You will not take it to current investment. When will you take it to current investment? When you put a fixed deposit, not for 3 months, beyond 3 months, that is 3 months, 1 day, up to 1 year. So if that is the term period of fixed deposit and remaining 2 conditions are satisfied, now this 1 lakh becomes your current investment, short-term investment. If you're putting a fixed deposit for 1 year plus 1 day and continues above that 2, 3, 5 till you die. I mean, anybody dies. Long-term investment. Long-term investment. Non-current investment. So are able to differentiate between 2. In your ratio topic, we have learned only these 2 categories: current investment, non-current investment. But in cash flow, we have additional terms and conditions saying that if an investment is short-term for 3 months, it is highly liquid, and the change in value is going to be insignificant. The risk of change in value is going to be insignificant. Then it is my cash equivalent. As investment normally qualifies as cash equivalent only when the short-term maturity is for 3 months or less than that from the date of acquisition. So how I got 3 months, you got it here. It is given in your textbook only. Let me give you another example. Once again, ma. Another example. I invested 1 lakh rupee in the share market. Invested 1 lakh rupee in share market. In share market, there is no lock-in period. I can put the money and withdraw whenever I want. So can I say the first category will be qualified? First category will be qualified, short term, highly liquid, because I can get my money back whenever I want. But third point, not qualified, because in share market, the value is subject to market changes, the change in the market value. So there is high risk of the value getting affected. It can go up significantly. It can come down. The value of investment can come down significantly. So can I treat this money as cash equivalent? Why should I know what is my cash equivalent? Because the money that I'm going to pay to current liability, from where will I pay? From current asset, no? In current asset only you have cash and cash equivalent. Cash and cash equivalent, that warrior will be readily available to me for making the payment to the creditor. If creditor wants the money immediately today, who is the first person who will come and stand to me? Cash, then cash equivalent. Then all the other people will come. So I need to know those 2 warriors, cash and cash equivalent, who will come and stand for me whenever I'm in danger, whenever I'm in trouble. So I need to know the 1 lakh rupees what I invested in the stock market, whether this warrior is going to help me or not going to help me. Can you rely on this 1 lakh rupees? No. Because today if you're investing, after 1 week, This 1 lakh can become 0 also. So can you depend on this person to make the payment to the creditor? So should I treat this as cash equivalent or should I treat this investment? Investment. Are you able to follow? Online people, are you able to follow? Is it making sense?
Yes, sir.
Yes, sir.
In the book, as you read, it says or less than the date of acquisition.
Correct.
Date of acquisition is next year. The thing that you next year final date balance sheet. It is definitely more than 3 months.
Which one are you talking about?
So,
See, when we did the ratio topic, we calculated the benchmark date. The benchmark date was always from the
next
year, a year and 12 months. So here, if you want to classify something as cash equivalent, you have to calculate 3 months from the date of acquisition is what they're trying to do. So from the date of acquisition, so let's suppose we are today preparing the balance sheet. Now with this 1 lakh rupees, I want to know whether this is cash equivalent or current investment. So for me to check if this is cash equivalent, what will I check? When did I invest money in the stock market? Date of acquisition. From there, I'll calculate 3 months. So if the investment is within 3 months, that is today's balance sheet date is within 3 months, then I'll go for the remaining 2 conditions. If not, it will be current investment or non-current investment. Didn't get the point? Wait, give me some time. Let me read the other part. Eventually get it. Trust me. One more time I'm reading, guys. Cash equivalents are short term. First condition, they have to be short term. Second, they should be highly liquid. And those values of investment should be subject to insignificant risk of change in value. The value that changes should be insignificant. The risk also should be insignificant. The change in value also should be insignificant, which means if change happens very nominally, I'm okay. But if there is a risk of significant change in value, then I cannot treat this as cash equivalent. They're talking about risk. If I invest in share market, can you 100% say the money will go down? Unless and until you're a bad analysis oriented person, then of course. Otherwise, it can go down, it can go up also. You can never say. So we are talking about risk of going down. We are not telling that confirm it will go down, but there's a probability of going down. And the risk is high is what we're trying to say. Current investment, unless specified otherwise, are taken as marketable securities and are included in the cash and cash equivalent. Please take a highlight and highlight this point. Very, very important from the examination point of view. Current investment, unless specified otherwise, are taken as marketable securities and included in the cash and cash equivalent. In the question, first of all, they'll give you marketable securities. What is the meaning of securities? What is the meaning of securities? Investment in shares, investment in debentures. Marketable means what? I can readily sell it whenever I want to sell it. Marketable securities, if they give you a question, it is investment. Will you treat this as cash equivalent or will you treat this as current asset or non-current asset? So in your syllabus, what they have told is that marketable securities will be treated as cash and cash equivalent only by default if they give marketable securities. Marketable securities, if they give you, by default in your syllabus, you will treat this as cash equivalent. Now,
But
sometimes
sir, there
they'll
will
not
be
give
a
marketable securities. Sometimes they'll give you in question only current investment, leave it. Sometimes they'll give you current investment and leave it. Now, in current investment, there could be 2 options. Investment up to 3 months, investment beyond 3 months up to 1 year. 2 possibilities are there. For example, guys, if I took first example, I did investment in fixed deposit for 3 months maximum. You said this is cash equivalent. Then I told you did investment 3 months, 1 day. That is beyond 3 months up to maximum 1 year. For a second, can I say both the scenarios, it is investment only? You've invested money somewhere. So technically both are initially current investment. Both are invested. So it is current investment. But specifically, if this is below or 3 months or below, it is equivalent, cash equivalent. If it is beyond 3 months, maximum 1 year, it is current investment. So which means technically both of them initially will be a part of current investment, later reclassified to cash equivalent if the terms and conditions are satisfied. Now what they're trying to say here is that in the question they give you current investment. They are not mentioning whether this is maturing within 3 months or whether it is maturing within 1 year. They have not given anything in the question. So what should you assume? You have to assume something, no? In the question they give you current investment. They give you the balance sheet. In the balance sheet, will they tell this is less than 3 months or beyond 3 months? So current investment is given in balance sheet. So why am I speaking about balance sheet? What is the underlying document to prepare the cash flow statement? Balance sheet and P&L. In balance sheet, you have current investment, boss. But whether it is maturing in 3 months or beyond 3 months is not given. So what will you assume? So here the assumption is that we will treat this current investment as into marketable securities, and again it is to be treated as cash equivalent. So current investment, unless specified otherwise, in the adjustment they tell the current investment which is mentioned above in the balance sheet is investment beyond 3 months. Like that, if they give a specific comment, then it is treated as current investment. If nothing is given, if unless specified otherwise, if otherwise nothing is given, we will treat current investment as marketable securities, and in turn we'll treat that as cash equivalent. So please take a highlighter, highlight this point. Very, very, very important. Because at so many places where we make where we prepare the cash flow statement, we will make use of this assumption. So very, very important. Please highlight it. Now, some people, when I say highlighting in the book, I don't know what happens to them. The inner artistic person comes out. So they'll buy that one fluorescent color, pink color, blue color, green color. One para blue, one para pink, one para. The purpose of highlighting itself is defeated. The purpose of highlighting itself is defeated. When you turn the pages during examination, everything is colored. So brain will say everything is colored. Next. Motivation to study. You take some other book and do it, man. Buy accounts book. Highlighting means what? In the entire page, if this is allowed highlighted, means what? This is very important. I have to go through. Which means others, if I don't go through also, I'm okay. But this I have to compulsory go through. So please highlight only whatever is required. Okay, come back. You guys are going in your own memory. Come back. I'll give break. After this only. Example of... Forgot. Example of cash equivalents are...
Current investments, basically when current nothing is mentioned, you will take it as
current investment, nothing mentioned means cash equivalent. If specified otherwise, maturing up to 1 year, then current investment. Maturing beyond 1 year, then non-current. I'll explain. Marketable securities, guys, marketable securities means investment in shares, debentures is called a security. Marketable means what? I can invest whenever I want. I can sell it whenever I want, which means my securities are marketable, which means there is a ready market available for buying and selling this stocks. So it's called as marketable securities. Guys, no talking when I'm talking. Example of cash equivalent is current investment, treasury bill, commercial paper, preference share. If these are redeemable within 3 months from the date of purchase, all these are called as cash equivalent. I've invested in current investment. The money is maturing in 3 months. What is it? Cash equivalent. Treasury bill is one kind of investment. I'm not going into detail. It's one kind of investment with the government. Commercial paper is also one kind of investment. You're investing in some other company's preference share, and that person is going to give you money back within 3 months, which is very difficult. Assume if it is going to come back to you within 3 months, then it is called as cash equivalent, provided the money that you've invested in the current investment, the money that you've invested in treasury bill, commercial paper, preference share, the value that you've invested, the value should not go significantly down. If it significantly goes down, then it cannot be qualified as equivalent cash. It'll go as your current investment only. So again, I'm repeating, for you to classify something as cash equivalent, all these 3 conditions cumulatively has to be satisfied. Please make a note of this point. Sir, what is my total cash and cash equivalent? Cash in hand plus add cash at bank. Cash at bank is demand deposit. These both are called as cash. And rest of the things are called as cash equivalents. So what is the example of cash equivalents? Checks on hand. In 11th standard, we saw a case. Received checks from Ram, but did not deposit in the bank. So what is the entry? Checks in hand to Ram. So check in hand, what is it? Cash equivalent. Because this is easily convertible into money in no time. So checks in hand or checks on hand, cash equivalent. Draft on hand. What is draft? Demand draft. Not bank overdraft. Bank overdraft is a liability, my dear. Demand draft. DD, have you heard about it? This is little bit outdated in current scenario. This was very prominent until 6-7 years back. And this NEFT RTGS was not there. So yearly, so 10, 12, 15 years before. So when we used to make payment to CA Institute, so we have to take a demand deposit from the bank and post it all the way to Delhi. So demand deposit is one mode of making the payment to opposite party. So your customer gave you a demand draft in hand. You could not go and deposit it. Like check only it is. You have to go and deposit. So demand draft, which is in your hand, is as good as money in your hand. So it is treated as cash equivalent. short-term investment, that is marketable securities. Current investment, short-term investment, marketable securities, which means what? Those three conditions satisfied. Means that they are short-term, highly liquid, and the change is going to be insignificant. That is the assumption. If that is the case, this is qualified as cash equivalent. Now let's suppose marketable securities is not given. Short-term investment alone is given. Still it is cash equivalent. For you to treat that as current investment under investment activity, the question has to specifically guide. Short-term deposit in bank. Deposited money in bank. Example I gave you. It is short-term. Second, it is highly liquidatable. Third, the change is going to be insignificant. The risk of change is going to be insignificant. The money should come within 3 months. So it is cash equivalent. So all this, if I add, this is my cash equivalent. Cash equivalent. Opening cash balance, closing cash balance, we learned, no? This is that opening cash balance and closing cash balance. So now in the cash flow statement, if you are asked how to calculate the opening cash balance by adding all of them, they ask you how to calculate the closing cash balance by adding all of them. By mistakenly, don't take the short-term investment to the investing activity. If you do that, gone. Full answer gone. So this segment of understanding is very, very important. If you do not understand that which item I should take into the cash and cash equivalent, which item should I take to operating activity, which item I should take into the investing or finance activity, if you're not able to differentiate, if you take the accounts wherever you feel like taking, the entire cash flow statement will get collapsed. That is why this is very, very important. Cash and cash equivalent forms a very important role in the entire cash flow statement format. Am I loud and clear, only people? Hello?
Yes, sir.
Yes, sir.
Chalo, let's take a quick break of 4 minutes. We'll come back and continue. Yes, people, welcome back from breaks. Let's continue. Cash flow. Cash flow is inflow and outflow of cash and cash equivalent. Cash flow exclude movement between items that constitute cash or cash equivalent because they are part of cash management of the enterprise and not operating, investing, financing. How many of you understood this point? Read it and tell me. I want explanation. Manisha? Cash flow excludes the movement between the items that constitutes cash and cash equivalent. What does this mean? Tanish? Krish? English man? Read no. Don't give up. Khan? Aman? Mridula? Dhanmant? Harshit? What is the meaning of this? Cash flow excludes movement between items that constitute cash and cash equivalent. You did tell full in school. Chapter also over. Still don't.
Cash is getting converted into bank, so that means it is not included in cash flow because that is a part of cash management. Between 1 to 100.
Okay. Point. Investment activity. You sold a furniture. Furniture sold, and for that you got 1 lakh rupees. Using this 1 lakh rupees, you bought another furniture. Furniture bought worth 80,000 rupees. What is my net flow? What is my net flow? 20,000 is my net flow. What does this net flow means? 1 lakh rupees cash I got. Source of money coming in. Diya? 80,000 is money going out. So after that, how much money is balance left in your hand? 20,000 rupees is the surplus cash that is left in your hand. So this 20,000 is called as movement in the cash flow. This is called as movement in the cash flow. This is called as cash inflow, cash outflow, net flow. On the other hand, I got 10 lakh rupees. I have 10 lakh rupees in hand, cash in hand. 10 lakh rupees cash in hand. In that, 3 lakh rupees I have deposited in the bank. So what is left in hand? 7 lakh rupees. In bank, the initial balance was 0. Now I deposit 3 lakh more. So 3 lakh is the net balance. So movement of the money from cash in hand to cash in bank. Can we consider this as cash flow? You're transferring from one pocket to another pocket. Can we consider this as movement of cash flow?
No, because both are your pocket.
Both are our pocket. So that is why they're trying to say that cash flow excludes the movement that is happening between the cash and cash equivalent. Cash in hand is cash. Let's suppose bank is your cash equivalent. So anything that is moving from one pocket to another pocket, cash is your pocket. Cash equivalent also your pocket. So anything that is moving between your pocket, can that constitute as cash flow? Can I consider as cash inflow and outflow? Am I trying to say that in the business 3 lakh is coming in? Here I can say in the first case 1 lakh rupees money coming inside the business. So cash inflow I can say money coming inside the business from the external person. This money is going out to the external person. So I can call this as cash inflow and outflow. But here 3 lakh rupees is got reduced in cash in hand and it got increased in cash at bank. Can I call this is outflow and this is inflow? No, because it is rotating from one pocket to another pocket. It is you who is shifting the money within your pocket. So cash inflow and cash outflow should be between the business and the third party, not between business and the business. So we will treat something as cash inflow and cash outflow only when the transaction is happening between the business and the third party. If the transaction is happening between the business only, it is called as cash equivalent, no movement of cash. Now from MCQ point of view, this is very, very important. I'll give you another example. Cash in hand, 10 lakh rupees. Or let's say cash is 10 lakh rupees. Cash equivalent, let's suppose you've invested in the fixed deposit for 3 months. Those 3 conditions satisfied. 5 lakh rupees. Now, the fixed deposit got matured on the 3rd month. So the money has come to your bank account. The money has come to your bank account. So 5 lakh rupees deposit closed. So deposit now it becomes 0. This 5 lakh rupees was the initial deposit. 3rd month it got matured. So deposit is closed. So this is cash outflow. And the money is coming here, getting added to your cash in hand or cash at bank. 15 lakh. Will I treat this as cash outflow? There is no outflow because this is the money that is coming from one pocket to another pocket. So this 5 lakh, definitely the outflow happened, but that came back again to my business only, from my one account to another account of mine. So here you will not treat this as cash inflow and the outflow. But if this 5 lakh rupees is coming from some external third party, which is good for the business, then that is treated as cash inflow and outflow. So shifting of the money from one pocket to another pocket of yours is not treated as movement in cash flow. Please mark this paragraph, very, very important. Cash flows are inflow and outflow of the cash and cash equivalent. Cash flow excludes the movement between cash and cash equivalent because they are part of the cash management of the enterprise. They are part of cash management, means they are my pocket here and the back pocket, both is for my management. So when I go and buy something from the market, whether I pay money from this pocket or the back pocket, it's my money. From wherever I want, I'll pay. So does not calls for cash inflow outflow. Now from the back pocket, I've taken the money and put in the front pocket. Can I say I got earned 100 rupees? No. So that does not call for a cash flow. So they do not come under any of the non-operating activities. Sorry, they do not form part of the operating activity, investing or the financing activity. Cash management is included as investment of excess in cash and cash equivalent. It is treated as the one segment coming down, another segment going up. Cash in bank coming down, cash in hand going up. That's all. Example, cash withdrawn from the bank for business. If cash is withdrawn, bank balance will reduce, cash balance will go up. So this is a movement only in my pocket. It is not a cash inflow and outflow. Cash deposited into bank out of cash in hand. But this should be for 3 months. Condition is that you should have deposited the money only for 3 months if it is for fixed deposit. Or if you're depositing as the current account balance, then anything is fine. So cash in hand will reduce. Cash in bank will go up. My one pocket is reducing, another pocket is going up. So this is the movement in cash and cash equivalent. It's not a cash flow movement. Sale and purchase of short-term marketable security. Marketable security is cash equivalent. You've sold it. So money will come either in form of cash in hand or cash at bank. So my investment is going down, cash in bank is going up. So one pocket is going down, another pocket is going up. So this is movement between the cash and cash equivalent. It is not a movement of cash inflow and outflow. Very quickly, what is operating activity? Inflow of money or outflow of the money for the core business activity. For the core business activity. What is core business activity? The main purpose for which you have started the business. The main purpose for which you have started the business is called as core business activity. What is the core business of FFLA? Education, tuition. So whatever money is coming from this segment, that is called as cash flow from the operating activity. If I'm into business of buying and selling laptop, so laptop is my core business. So by selling the laptop, whatever money I get, I call it as cash inflow from operating activity. Now I have a staff, a teacher, I'm paying salary. So the salary that is paid to the teacher, is it operating activity expense or other activities? Operating, because teacher is taking care of the business main operation. No? So it is cash outflow of the operating activity. So operating activity means what? Operating activity are the principal revenue producing activity. Principal revenue producing activity means what? The main purpose for which you started the business, no? That from that purpose you are getting the revenue. That is called as principal revenue producing activity. So in my business, what is the principal revenue producing activity? The coaching class fee that I collect from different people. That is the primary thing. Now, let's suppose the additional money that I saved, invested in the fixed deposit. That means I'm getting interest. Can I qualify that investment ka interest what I'm getting? No. That interest can I qualify as operating activity? No. Did I start this business that one fine day I'll earn interest income? That is not my core motive. My core motive is to earn money from the coaching business. So therefore, the coaching segment fee, what is coming is the main principal revenue generating activity. So operating activity are the principal revenue producing activity of the enterprise, and other activities that are not investing in finance. Anything which is not investing in financing is my operating activity. So what is my investing activity? Investing means what? Money that you have paid in acquiring of the long-term assets or other investments which are not cash equivalent. For example, if I buy land, for that I paid 1 crore rupees. What it is? Cash outflow, because I paid money, cash outflow. But which activity? Operating activity. Investing activity. Investing activity. Number it is what activity? Investing activity. I have purchased building, plant, machinery, furniture, office equipments. All is my investing activity. So cash outflow of the investing activity. I put investment in fixed deposit 5 years, long-term deposit 5 years. So it is my which activity? Sir, I have deposited money in fixed deposit. So cash outflow of the business, cash outflow. Current or non-current? Non-current, because beyond 1 year. So it is a cash outflow of the investing activity. I have invested for 5 years. Disposal, I sell the asset. From that I got money. So cash inflow from which activity? Investment activity. So are you able to understand what is invest? Name itself is saying investing. Anything that I've invested in the business, through that money is coming in or going out. Investing activity. No big rocket science. Online people, are you all with me?
Yes, sir.
What does financing activity means? Financing the business means what? Raising the funds of the business. So issue of share capital, issue of equity capital, preference capital, issue of debenture, getting money from the banker, NBFCs, third party, friends, relatives is all way of financing my business. So through that money is coming in. So it is cash inflow from finance activity. So finance activity are the activities result in change and size in composition of the owner's capital and the borrowings of the enterprise. So equity and debt. If that is getting changed, if more equity is raised, cash inflow. If I'm redeeming the debentures, if I'm redeeming the shares, buying back the shares, cash outflow. All this is finance activity. So outer line you got it. I'm not going into deep because I will be discussing all this activity in depth in respective classes. Today I'm just trying to give the outer line circle of the 3 different activities. About this in depth we'll discuss when I come to the operating activity separately, investing separately, finance separately. Outer line flavor did you get of today's thing? Yeah.
Investing includes both core business and non-core business.
Yes. Investing includes both core and non-core. I know I invested in plant and machinery. The plant and machinery is helping me in my business, generating my revenue. At the same time, I invest in share market for 5 years, let's say fixed deposit for 5 years. So that investment is for non-current. So that all will go to your investing activity. Now, again, there is a difference. Again, that how you should deal with those scenarios, all will deal with it when I come to these 2 activities. So intricacies of this will be discussed separately. I'm not going too much in depth. 1 second, na? Tell them.
So the moment we cash and cash equivalent, third one, profit and loss or sale
Profit and loss on sale of asset. So profit on sale of asset is a cash inflow. Sorry?
Profit and loss on sale of marketable securities.
Okay, let me take an example here. 3 lakh rupees invested in the marketable securities. So this is my cash equivalent. So this is sold for 3.2 lakh rupees within 2 months. So first point is marketable security. So by that virtue, it is a cash equivalent. So 3 lakh rupees to 3.2 lakh rupees you have generated. So this is my cash inflow. So this cash inflow will be a part of my which activity? So this cash outflow, 3 lakh rupees invested. So cash outflow, will I treat this? No, this is my cash equivalent. It is cash equivalent. 3.2 lakh rupees you have generated. So 20,000 extra profit you have generated. Now, will I treat this as cash inflow or not?
No, sir, because it is the same point of view. Cash
Between cash and cash.
yeah, between cash and cash. Because that excludes the movement of
Doubt is there. Doubt is there. So what should we do now? Wait for when we come to investing activities. So when I take the operating segment, so I'll tell you what am I supposed to treat, how will we treat this in the cash flow statement. This is too early to comment. Very good question. I appreciate. But too early for me to discuss at this stage to understand. So this will get covered in next 2 or 3 classes. Probably next class will not get covered. From the 3rd or 4th class onwards, this will get covered. Up to investing activity, there will be multiple scenarios which is coming here. Automatically things will start getting clarified because we have these questions in the textbooks. So can we hold till then? Hello, madam? Till then, can we hold it? No problem. Okay. With regard to profit from the core business activity and non-core business activity, income from the core business activity, non-core business activity, you discuss somewhere in the ratio topic. Where? To differentiate between revenue from operation and other income. What will go to revenue from operation? If the income that is generated from the core business activity goes to revenue from operation. The income that is generated from the non-core business activity will go to your other income. We studied that. Then we studied one more point there. If you are a financing business, then what is your core business activity? For non-financing business, what is your core business activity? We have dealt that also. Yes or no? So there are 2 types of business. One is non-finance business. Another is finance business. What is non-finance business? Buying and selling of laptop, buying and selling of jewelry, coaching class. Any other business that you can name? Boutique shop. Trading of what? Restaurant business. All this is non-finance business. In non-finance business, either you are a dealer of goods or services or both. You are dealing with products or services. That is called as non-finance business. That is called as non-finance business. Is it my phone?
Not mine.
Where is it? Sorry. What is a finance business? What is a finance business?
Banking.
Finance business. Brokers. What does broker do? Brokers come under this category. Finance means what? Lending or investing business. Bankers are into lending business. They take money and they lend it. On that, they earn money. Service only, no doubt. But this is specifically finance business. Venture capitalist invest money in multiple securities. They invest in your company in form of equity share, preference share, NBFCs. All these are called as finance activity. So NBFCs, non-bank financial institutions. So all these are my finance activities. Now here, what is the main core activity? Investing. Lending is the core activity. From that, in return, what will you earn? If you're lending the money, you will earn interest. If you're investing, you will earn dividend. So here, if you're a finance business, if you're into finance business, we have discussed this already in the ratio topic. Second time I'm discussing. If you're into finance business, you're financing somebody. You're financing money, you're giving money to somebody. That is called as finance business. You understand what is finance business? So as a lender of money, what will I get in return, boss? Interest. So this is my core business activity. This is my revenue from operation. This is my cash inflow from operating activity. Whereas the non-finance business, let's take FFLA. FFLA's core business activity is what? Coaching fee. So coaching fee is what? My operating activity. So let's suppose I invested money in fixed deposit. I'm earning interest. Can I treat this as operating activity? No, it is my investing activity. So for a non-finance business, the core business activity will be different. For a finance business, the core business activity will be different. For us, if interest is investing activity, for a finance business, the same interest will be his operating activity. So you need to understand the nature of the business. So this is not the first time I'm discussing. This is already discussed. Tell me if you have any difficulties in this. Let's take one example. Illustration 1. Now you'll be more active. Identify which of the following transactions are classified or shown as operating activity of a non-finance company. Non-finance company example, please.
Restaurant.
FFLA. I love it. First FFLA, then only second everything else. After FFLA, one more. Kalpurix Academy. Branding, marketing. After that, you say what you want to say. Restaurant.
Tasty Bites.
Tasty Bites. Yes. Chocolate factory. Cake business. Okay. Non-finance business. Now, first activity. Cash received from sale of goods. Cash received. First of all, inflow or outflow. Khan inflow or outflow. ये तो बता दे भाई. LKG वाला कोई बोल देगा. Very good. Khan says cash inflow. From which activity, Khan? Operating. Because for a non-finance company who's dealing with goods and services, selling of goods is the primary motto. If he's in the business of buying and selling laptop, so selling of laptop and getting money from that is my operating activity. So cash inflow, operating activity. Next, Tanish, cash paid for purchase of goods. Cash paid, inflow or outflow. Cash outflow. Purchase of goods. Which activity? Core business activity. Core business means what? Operating activity. Online, let me ask somebody now. Arya, you there?
Yes,
Arya.
sir. Hello.
Yes, Arya. Payment of salary and wages. Cash inflow or outflow?
Outflow.
Cash outflow. Which activity?
1 second, sir.
तू आंसर देके नहीं बोलेगा.
उसको नहीं है सर, आंसर तो नहीं है.
आंसर भी नहीं है तेरे पास? Okay.
Sir, operating.
Why it is operating activity?
Sir, business. The work is done happening. The business related work is happening. Manufacturing.
Core businesses के related ही work चल रहा है.
Yes.
Okay, the salary that I pay and wages that I pay is for my employees. What is my employee doing? Is my employee working for my core business activity or for somebody else? For developing my core business activity. So obviously it is my operating activity. Cash outflow operating activity. Divyansh is there online? Harshit is saying good night, Arya. You have to give him back answer. Huh? He gave an answer, proper answer. Arya is listening. Divyansh. Divyansh Mehta.
Yes, sir.
Payment of interest on loan. Cash inflow or outflow?
Interest on loan. Okay.
Inflow or outflow? Somebody is telling you are very power.
So cash is outflow.
Cash outflow? Which activity?
Operating activity.
Operating activity. Very good. Arya, which activity?
Sir, 1 second, sir. Financing.
Very good. Divyansh, you want to change the answer?
So 1 minute.
Naman, payment of interest on loan. Investing activity. Okay. Investing will become when you are giving loan to somebody. You have advanced the loan to somebody. You invested in somebody else's business. So on that interest, if you get investing, it makes sense. You are a non-finance company. So non-finance company will not fund. No, they will take funds. So you have taken the loan, boss. So you have taken the loan means you raise the funds. Raise the funds means raising the finance. So in relation to that, if you pay interest, it becomes a finance activity. No? Making sense? Divyansh, making sense?
Yes, sir.
So cash outflow, finance activity. Now, repayment of loan. Loan, financing. Loan means raising funds. Raising funds means raising finance. So cash outflow of the finance activity. Any problem? Purchase of machinery against payment. Purchase of machinery. I'm investing in machinery.
So investing.
Yeah. So cash outflow, which activity? Investment activity.
Cash outflow, investing.
Very good. Online, who answered now, girl?
Mehak.
Super. Somebody is listening. Dividend paid. I'll ask specifically. Diya. Sir, paid means cash outflow, sir. What chiller question? Relation to which activity? Finance activity is what she's saying. Others. Operating activity. Somebody say investing also. All the three options you say. For me, I'm playing Kon Banega Crorepati. You have to answer. No. Investing activity. Dividend paid. You're not receiving dividend. Paid. You pay dividend to your equity shareholder. From equity shareholder, you got money. So you have raised the funds. So issuing of equity share capital is financing activity. So dividend, what I pay in relation to that also is financing activity. So cash outflow, finance activity. Guys, you will take solid initial 1 to 2 class or even 3 class to understand which transaction is coming under which activity. Very, very important. Sale of car in cash.
Cash
Inflow or outflow?
Inflow.
Sir, when I sell car, I get money. So it is inflow. Surya, which activity? Why investing? So I've invested car earlier. So I've sold it. From that source, I've got the money. Investing activity.
So how do you know this is of a person?
Now she's asked. Sorry.
If it's a car business, there will be op.
Now the good question. She's asking, sir, how do you know if this car is an asset or is it a item that we are trading? So now, had this been a goods, in the beginning they would have mentioned that we are a car dealer. So in 11th standard, I very clearly told you, with regard to assets, if they don't tell that you're a dealer of so and so asset, then it becomes your asset. For example, furniture. In 11th standard, you had a question. So how do you know that you're using this furniture and not selling the furniture? A donkey fellow. If this was furniture to be sold, then the heading would have been that this is a furniture dealer. If it's a furniture dealer, foreign buying of furniture is as trading. It's not for using purpose. Same way here, the car that is being purchased earlier, had they told that this is a car dealer, had they told this is the car dealer, then this car is your operating activity. But if nothing is mentioned, that this car is used in the business. So you've invested in car, so investing activity. So buying of car, selling of car. Buying of asset, selling of asset, investing activity. So cash inflow, investing activity. Commission received. Commission received. Online people. Commission received. Two possibility. Now listen. Now let's suppose FFLA takes accounts classes, all of you know. Now some student has come and approached, so we want XYZ class. So I'm referring to a teacher. And telling teacher, hey teacher, I referred you, give me commission. So if I get commission, okay, now I'll come to Purvi later. Wait, I'm coming. So that commission, is it operating activity commission or non-operating? Core business or non-core business? Core business. Because it is coming in relation to my business. Core business activity. Imagine some random person wanted to buy a land building. I just referred him on property. That deal got converted. Now I got commission. Now I got commission on the transaction that happened between two parties of selling the land and building. Core business or non-core business? Non-core business activity. But still the question remains, operating or non-operating?
Operating.
I'm telling you, I am FFLA. FFLA has got commission for dealing between two parties for land and building. Operating or non-operating? Is dealing between two parties for land and building my operation? If nothing is mentioned, always operating. So here we don't know anything. So it is operating. But I'm giving a scenario where I'm referring somebody in my business. Out of the business, I'm getting some commission. Nowhere related to my business. So it becomes a non-operating. Are you able to follow? So here nothing is mentioned means it is cash inflow, operating activity. Unless when I mention otherwise, always commission received to be treated as operating activity. Amount of cash and checks received from trade receivable. Debtor. From debtor I got the money. So cash inflow. Operating activity only. Because I'm getting money from debtor, no. Why is he giving me the money? Because of selling the goods from my business. From my operation, I sold the goods to him. From that, I got the money. So it's a cash flow from operating activity. So what? Hello. Wait. You got money from the debtor. Is it not a cash inflow? Is it coming from one pocket to another pocket? Had the money come from, let's say, by selling the securities, short-term securities or market-term securities. So it's one pocket from one to another pocket, the money is coming. This is coming from a third party, no? Is it not a cash inflow? Using this money, can you not do a lot of things in your business? Cash inflow from operating activity. So 1, 2, 3, 4, 5. How much we discussed operating activity? 1, 2, 3. 4, 5. Correct? Perfect planning. So here the problem is they have told what is operating activity alone. Now I have given you a hint that apart from operating activity, other transaction is pertaining to which activity. That also I have given you. Please make a note of it. I want all of you to make a note of the other activities also. Online people, have you made a note of it?
Yes, sir.
Yes, sir.
Illustration 2. 2, 3, we're done with it. Yes. Yeah, we can go and come. Bye. Idea which of the following transaction is classified or shown as operating by the financial company. What is the work of a finance company? To finance funds, either by lending it or by investing it. So what is their main core business operation? Getting interest and dividend is the core operation. So payment of salary and wages. By such financial company cannot have the employees. What will the employees do? The employees will sit and analyze the balance sheet of the company, whether this company is good to invest or not. So for that, you're paying salary and wages. Any problem? So this is cash outflow operating activity. Take the answers, no? Sometimes when I can be wrong. Like that, you can expect and think. Never happened. Some people wish, sir, sometime you go wrong, no? क्या कर रही है? देखो कभी no कभी if you want to paint people, no, you tell I'll organize a session, paint the people session. You sit and paint, color, putting whatever you want to do. Not in class. वो डर गई है क्या कर रही है? Payment of interest on loan taken. Sure. Concentrate. Payment of interest on loan taken. Payment of interest on loan taken. Loan taken by finance company. Finance company itself is taking loan. So for that you're paying interest. Now tell me. All in people waiting for responses. 3 donkeys left the meeting without informing. See? Payment of interest on loan taken.
Operating activity.
Bank, they will lend money to the customers, no? But they'll accept deposit also, no? So, or even they can take, bank also can take loan. So bank will take loan from RBI. So bank will have certain financial institutions from where they can take loan, because bankers also need funds, no? So loan taken, payment of interest on loan taken. Operation. So taking of a loan is a normal operating activity, or is it a finance activity? Now in this textbook, now here what they have given, operating activity. Here operating is given. Now the same question we'll see in the future where they have taken this as finance activity. Finance company only I'm talking about. Yeah. So this has always been a debate. In certain places, they have taken loan taken or interest on loan taken as financing activity. In some places, they have treated this as operating activity. Here, I think they have taken as operating activities if I'm not wrong. Yeah. In non-finance company is no problem. By default, finance activity. But for finance activity, there is 2 opinions. In one place, here they have given operating activity. Somewhere in theory, I remember reading it. They have treated this as finance activity. So this alone will keep it pending. We'll conclude not now. When the right time comes, I'll conclude what you're supposed to do with this. Now, receipt of interest on loan given. Loan given. Main operation is giving loan only. So interest on that, what you get is cash inflow from operating activity. We have no debate in this. The main purpose of finance business is lending money, boss. You give loans and advances. You invest in the securities of the business. So in return, whatever interest and dividend you get is the cash inflow from the operating activity. No doubt. Purchase of shares for trading. You're purchasing shares for trading purpose. Trading. What is the meaning of trading? Buying, selling, buying, selling, buying, selling. I have started a company. In that, my job is only buying the shares, selling the shares. Trading means what? I buy it, I sell it within a very short term period. I don't hold it for long term period. Long term period, if I hold it, it is investment. Share market, buy and sell very frequently is called as trading. If I invest in any shares and hold it for a long term period, that is called as investment. So here they are doing trading. So cash outflow, operating activity. Purchase of shares for trading purpose. I buy and sell regularly. My business is that only. My business, a lot of people after COVID, they've started trading business. Continuous trading. The only thing that they do from morning till evening is buy, sell, share, sell. Intraday. Intraday means what? Buying the shares, 100% sell it in the same day itself. That is called as intraday. Some people, they buy it, they hold it and sell it after 2-3 days when the price goes up. That is called as trading. So in normal scenario, what do we trade? We buy laptop, sell laptop. That is called trading of goods. Here, this is trading of shares. You buy shares, sell shares. Operating activity. Operating only, no? Purchase of shares for investment they've given. Chiller, sir. Cash outflow, investing activity. So this person has invested money in Tata share and is not having any intention to sell it for next 2 years. Long-term investment, investing activity. He knows that over a period of 2 years only this share will grow to that extent. So it is an investing activity. Name itself says investment. So cash outflow, investing activity. Online people, any problem?
No,
Purchase
sir.
of shares on behalf of customer. Purchase of shares on behalf of customer. Cash outflow. And next one is sale of share on behalf of customer. Cash inflow. Operating?
No.
I'm not buying for myself. If I buy for myself and sell it for myself, it is my operation. I'm buying on behalf of somebody else, my customer. This used to happen in the earlier scenario. Now it is not applicable. Today you have so many other platform. You are not reliant on the broker. This is a concept related to broker. So today we have something called as Zerodha app. We have something called as Grow. We have Angel Broking. We have IIFL. You take a phone. You just go to your application. Click of a button, you buy. Click of a button, you sell. You are not dependent on anybody. But in those olden days, what used to happen is people did not have demat account. So the brokers used to have account with the stock exchange. So if I have to buy anything, I will tell my broker, please buy it for me. Please sell it for me. So I'll give money to my broker. So broker will use that and buy it. And whenever he sells, he'll get the money back to me. So it is this investment activity. It's not coming under operational activity because on this, I will not gain any income. On this, I will not get any income. On this transaction, whatever commission that is coming, no. Commission that is coming on these two transactions is my operating activity. Here the money will come in, go out. Coming in, going out. So it will be a part of my investing activity. Are you able to follow? It will not be a part of your operating. It cannot be a part of operating activities. All I'm trying to say.
What returns will you get?
Commission on this. So you buy the goods on that person's behalf, whatever value you're buying. So on that 0.01% commission you get. For the share that you're selling it, on that you'll get slightly higher commission. So that is the operating. This used to happen in the old scenario. Today is this literally outdated business. So the money that is coming in by selling off the shares on behalf of customer or purchasing on behalf of customer is cash outflow, cash inflow, but not of operating activity. Not of operating activity. So whatever money is coming in, that is you have purchased the share on behalf of customer, invested, sold, got the money back and gave it to the customer. So it's not an operating activity. Yes, please. Correct. Operational activity means what? Commission, what you're getting on this transaction is your operating activity. Here the money is coming and going out. So like that, if you say, even the plant and machinery, what you're buying is for your business only. Are you able to follow? So that is not the core factor to be determined. So purchase of share on behalf of customer, on behalf of somebody is not your investment. I mean, it's not your main operation of the finance activity. So it's not qualified as operational activity.
Sir, you are supposed to get some returns on your investment. So that amount of money you make in investment. If you purchase or sell shares on behalf of the customer, it's the customer that's going to get.
Absolutely. Absolutely.
How can you classify it as your investment activity?
Okay, the money what is coming in, then where will you classify? Operating not possible.
Operating not possible.
Finance can you classify? No, Chumma you're not classifying. So okay, forget for a moment. Let's suppose that it's not investing or finance. If you put in operating, will it make sense? Then where do you put it?
But it's not making sense in investment.
Operation may make sense. For example, if I'm buying my own shares and selling my own shares, I'm trading in my own shares. I'm the owner. I'm buying it. I'm selling it. Then operation makes sense because I'm a finance activity. Now here you're buying it on behalf of your customer. So buying on behalf of the customer is not my operation. It's not. So where will you classify this then? So that's why I'm telling you it will go either. Okay, we have to differentiate between investing and finance. So let's say investment is one option. If I take it to finance, will it be right? She's saying investment is not right either. So where will we take it? If it is not taken to operation, either investing and financing. We can debate between investing and financing. I'm agreeing. So some people will tell that, okay, you got the funds, you've raised the money from the customer, and now you're investing in the shares. So by that virtue, if I take it, put finance, that will be wrong. Now she's telling that, sir, even investment in what way it makes sense, because you are the person who's holding the investment in your account, but it's on behalf of the customer. So investment, you're owning it, or your investment. You're not in CA Foundation. Actually, okay, in CA Foundation is a concept where you say the stock that is there in your godown is your closing inventory. In CA Foundation, we have a concept called as sale of goods on approval return basis. So where you sell the goods, you send the goods to your wholesaler and supplier. He will not take the ownership, but the stock will be physically with the customer. At the year end, when I classify the inventory, I'll classify the inventory as my inventory with customer. So same way here, this is not your investment. This is investment in your hands on behalf of the customer. Hence, it is investment. Is the reasoning sufficient?
But wouldn't you have received the money already by selling the investment? So it becomes a job.
Sorry?
Wouldn't you have received the money already?
No, immediate doesn't happen. No, purchase of shares on behalf of customer means the customer will give order. I want to buy this shares. Please buy it. He'll buy it. So the amount that I've invested is which activity will I put into? Investment only. No, I've invested. So when I sell, I'll get it back. I'll be able to understand. So investing means what? Investing in your own shares, in your own name. This used to happen in old days. That's what I'm telling. Today's practical sense is not even applicable. Now you're in this scenario. Olden days, what used to happen is we did not have demat account. So if the broker is buying the share on behalf of us, who's holding that investment is my question. The broker is holding. So for broker, it is investment. No, though the ownership is for me, it's with me. But investment, who is holding? That person. I'll be able to follow.
So
Yeah.
that return on investment, when you give it back to the customer, then when your investing activity only go up.
No, when you get a commission on these transactions, goes to operating activity. Profit and loss will go to the owner only. Let's suppose you purchase a share for 100 rupees, sold it for 120 rupees. So 20 rupees is the income for the opposite party customer. For you, nothing will come. Now on this transaction, you would have charged with brokerage 0.01%. On this 0.02%. So that brokerage is your cash inflow from operating activity. Issue of debenture, last one. Financing activity. Issue of debenture. You have issued debenture. This is financing company. You're issuing debenture. Issue of debenture. Finance company is issuing debenture. So you're receiving funds or giving funds? Finance activity, investment, operating activity. So financing company also can raise funds because you also need money to invest. If this is financing activity, then payment on interest on loan taken, why cannot this be finance activity? Then here they have classified interest on loan as operating activity. Why?
Because that's the core business. And this is
Loan is raising funds. Debenture also raising funds.
business is money of giving
So debenture you raise for what? For further giving it. No.
selling your own company's debenture.
Correct.
So that's finance.
What is the meaning of finance activity? Finance activity means we're raising the funds.
You're raising funds here.
Raising the funds. Why am I raising the funds in loan or debentures? So that whatever money I get from these two sources, I can forward it to my customers. On that I can capitalize the money. So if debenture, what you're issuing of even of your own company, if this is a finance activity, then loan taken from the banker, why cannot this be as a finance activity? Correct? No, interest or loan, anything with relation to that is same activity only.
But interest is paid on day, like it affects the day.
For example, if let's suppose You come here, have they given interest here? Yeah. Payment of interest, repayment of loan, or taking of loan. Everything we classify as finance only. We never differentiated because everything is related to finance only. So taking loan, paying interest, and repayment of loan, all the three are finance activity for a non-financing business. But when it comes to the financing business, here interest on loan they have taken as operating activity, whereas issue of debenture is treated as finance activity.
So debenture is a part of capital.
When? Since when?
Like capital.
Still raising of funds, finance activity. No, capital, what do you do? Finance activity. You issue share capital, you issue debentures, take loan from bank. Everything is finance activity.
So for the banks, the financial institution's primary thing is lending and borrowing, right?
Correct, pa. My question is, point number 2 and point number 6, what is the difference? Both underlying are loan and debenture. Both are finance only for the business. I'm taking loan, I'm taking money from debenture holder. I'm taking money from banker, I'm taking money from debenture holder.
So whereas debenture is a marketable security also.
So what? If a marketable security is given, means you are treating that as cash equivalent. Nothing is given. I mean, issue of debenture is from long-term perspective. So first point, short-term point itself is disqualified. Those 3 points, remember. Those 3 points, what is the first point? It should be short-term. Second, it should be highly liquidable. Third, insignificant change value. Debenture, unless given otherwise, is always long-term. That's what we study in ratio topic. So first point itself is defeated. So it cannot be marketable security.
So maybe the first one is like you're earning from that, and the second one you're means that's shareholders.
Okay, issue of debenture. Once you issue the debenture, you have to pay interest. So payment of interest on debenture. Now tell me.
Yes, so that's shareholders fund and that's our earning. That's like P&L account.
So debenture holder may not be a customer, sir, but the loan holder has to be a customer.
Loan, I'm not giving loan, I'm taking loan.
Taken loan.
Banker lends loan to the customer. So that is giving loan. So banker is taking loan from RBI. Then on that they are paying interest to RBI. So this concern we need to address. We'll address eventually. Don't worry. We'll address this eventually. It's too early to discuss now. Last illustration. State a transaction that is classified or shown as operating activity by both non-finance company and finance company. Whether you're a finance company or a non-finance company, both of you show one transaction as operating activity, which is salary, bonus, gratuity. Whether you're a finance company or a non-finance company, you have to keep the stuff. For you to pay salary, bonus, gratuity, both are always operating in nature. So this illustration mark is very, very important. It's a very unique, odd question. My request to all of you is that prior to this illustration, they've given a couple of examples of non-financial company, financial company. Please go through. So next class when I come, the first thing that I'll do is go through these examples, explain few of them, and then I'll go to the next part, which is the investing and the financing activities. Am I loud and clear with this? One second. I'll just wind up. Guys, any doubts here? No. So when are we meeting again? Tomorrow 6:30 p.m. sharp. Right? Online people all set?
Yes, sir.
Hello. So yes, people, that's all from my side for today's session. I'll see you on the next class, which is on Monday, tomorrow 6:30 p.m. Until then, bye-bye. See you. Take care.
Thank you, sir.
Thank you.
Yes, sir.
Thank you, sir.